All right, a far more substantive conversation about the economy will take place on Wednesday when Fed Chair Jerome Powell holds his press conference. No rate cut is expected, but investors will get an update on the Fed's battle against inflation as they try to bring it back to that 2% target. Here now, Barron's latest cover story. Don't expect the Fed to cut interest rates this year. The Federal Reserve under Jerome Powell had planned to lower interest rates in 2024. Persistent inflation and a strong economy are getting in the way. Here to break down that cover and the entire story, why they're convinced rates will stay higher for longer, Nicholas Jasinski, senior economics writer at Barron's. Great to have you here, my friend.
Hey, Dave.
Good to see you.
I thought about coming in with Band-Aids on my face, but I wasn't sure if your producers would be okay
That would have
with
been a bold move. Sunglasses and a beer, even better, Nicholas. I know you were glued to that live stream on Friday. Just don't lie to me.
It's fun to watch. It's fun to watch. I would not make investment decisions based on that, though, like you said.
I think we agree there. Nice to see the Fed chair on the cover story there. And you don't expect, big lead, any rate cuts this year. Why?
The economic data just does not support it. And so, no, we see no Fed cuts this year, probably not until 2025, but that's not the end of the world. It's because the economy is strong, the consumer is resilient, the job market is tight. These are all good things.
The market had gone from like 6 to 3, still pricing in 1 to 2. Why do you think they're wrong?
You know, if you told me at the beginning of the year that we would go from 6 rate cuts priced in to now a little bit over 1, and that the market would be up 13% year to date, I would have said, no way. But you know, it's because the economy is so resilient. That means more earnings growth for more companies. And most investors I speak with, they would prefer an environment where you have broader earnings growth and fewer rate cuts over one where the Fed needs to come in and rescue the economy by cutting rates.
How do you account for that resilience of the market?
For me, it all starts with the jobs market and the consumer. Consumer spending is almost 70% of US GDP. And we saw the jobs report on Friday, 272,000 jobs added last month. That blew through expectations. The unemployment rate at 4%, wages were up 4.1% year over year. That's keeping consumers spending money. It's keeping demand going in the economy, and that's just helping earnings for more companies, and that's supporting the market. Then you get this AI kicker on top of that, which is going to do what it's going to do regardless of what the Fed or the economy does.
No doubt about that. The Friday data seemed to contradict the ADP number, and around here in these circles, no one was buying the jobs number. They believed, indeed, the wage growth, but there seemed to be a lot of suspicion about the jobs number and the strength of the labor market. Do you share that opinion?
So, you know, the ADP number and the official data have kind of diverged over the past year, and that's a whole story in itself. I think that's something that we don't fully understand why that has been. The wage growth is serious. I mean, so job openings are down, but they're still well above what they were before COVID. There are 1.4 unfilled positions for every job seeker out there. That means that companies need to pay up to attract new workers and to retain the workers they already have. As for the non-farm payrolls growth last month, there were slight downward revisions to previous months, so that tempered it a little bit, and we may get another downward revision, but it's supported by other anecdotal data and other data that we've seen throughout the economy. So I'm not too skeptical about it.
Circle back to the cover boy, which of course is Jerome Powell, and you don't expect, obviously, a cut on Wednesday. What do you expect him to say, though?
Yeah, it's going to be all about the press conference. The Fed also gives their quarterly summary of economic projections, which is all the Fed governors and the Reserve Bank presidents give their forecasts for the remainder of this year and the next 2 years. I'll be definitely looking at that. I'm very interested to see how last time they gave that in March, the consensus or the median estimate was for 3 rate cuts by the end of this year. I'm interested to see if that goes to 2 or even to 1. And what happens with their estimates for inflation this year and next year. It's been sticky. We've talked about that a lot on this program. Everybody's talking about that. Do they see it still going smoothly down to 2% in the next couple of years or not? We'll see. That's what I'm really interested in.
Do you see it going to 2%?
I don't think so, not this year. And 2025 is tough too. When you look at under the hood of the report, services are really that's the problem part of it. That's reflective of the tight labor market. Wages are going up. Service-intensive businesses are passing that along to customers. And then there's the whole housing element of it. The Fed, by changing interest rates, they can't build more housing. There's just a shortage of homes for sale and not enough homes being built in the US. That's keeping housing, which is 35% weight of the CPI. It's a slightly smaller weight of the PCE price index, which is what the Fed looks at, but that's still that's running in between 4 and 5%. For that to continue running at that rate, the rest of inflation needs to be 0 to get to a headline number at 2%. So we're not going anywhere close to 2% in the foreseeable future. That's our view.
Some really interesting data coming out in the last couple of days that shows housing supply starting to creep up, in fact, in all 50 states. We will stay tuned to that. But back to the 2% target, do you think at some point Jerome Powell and the Fed have to accept a number closer to 3, or do they need a recession?
You know, that's a tough one. I think either, there's sort of two paths. One is either the Fed puts us into a deep enough recession to get to 2%, or we settle out somewhere in this 2.5-ish range. As for them adjusting their target, I think it would be a disaster for the credibility of the Fed if they abandon that 2% target before they reach it. Once we get to 2%, every 5 years the Fed does this review of monetary policy. That's coming up for review in 2025. I don't see them adjusting that target before we get to 2%, because it would be seen as the Fed just capitulating and giving up on the fight, and that puts their future credibility into question.
If they see some positive data and we're right about to hit the election, how does that factor in, do you think, for the Fed? Because perceptions certainly matter in this case. How does the election factor into a September, November decision?
Yeah, so every time the Fed official is asked about the election, they say we're apolitical, we don't look at it, it's just something that's not in our theater of operations. Come on.
We don't believe that.
Sure, they're not going to say that publicly, but these conversations happen on the sidelines. There is a Fed meeting the first week in November, the day after the election, and the day after that it's a Thursday decision, which is a weird one, because I guess they don't want to be too close to the election. I think the optics of that are just so bizarre, and they're not going to want to make waves at November. So I think November is off the table. September, for some of the reasons we just talked about, the data is not going to be justifying a cut by September, and that leaves December for a potential move on interest rates this year. We still think that inflation is going to be too high, the jobs market is going to be too tight for the Fed to need to cut. And again, this is a good thing. It's because the economy is strong.
We forget it's a very good thing, the job creation that we saw on Friday. We used to celebrate it. Now it's the opposite. But if we see job growth continue along that path that we saw Friday, what, if anything, could cause a reversal and a Fed hike?
I think the hurdle is very high for a head hike. I think that you need to see the inflation numbers not just stalling out sideways like we have, but actually turning up. And you've had some help on the good side. The wage growth continues to be very strong, 4.1% in May, but that is down from what it was last year. So right now you have this kind of stalling sideways. You need to see inflation numbers actually turning up for the Fed to start seriously talking about hikes. They'll always say at the press conference, nothing is off the table. They want to preserve maximum flexibility for future moves, but I don't think there's any serious discussion of a hike yet.
So higher for longer remains the case. What do you think that means for markets? I know you don't give exactly a target, but basically overall you think what in terms of the S&P?
Yeah, I'm not going to give you a point number. I don't see a big drawdown in the offing. Once again, you have this ballast of earnings that are continue to rise, and the AI trade, just people are so excited about that. We have a big Apple event today that's going to keep AI in front of investors' minds. NVIDIA shows no sign of stopping. These are big companies at the top of the index that have an inordinate influence on what the S&P 500 does. So I think the S&P 500 between now and year end, maybe you get a couple percentage points in either direction, but no huge moves. As for next year, we're talking about the longer term economic outlook, and that's a pretty cloudy crystal ball right now.
All right, speaking of a crystal ball, I got to share this story with the viewers. You first came here as a young kid on a field trip. If someone could have looked in a crystal ball and said, wow, he's going to end up the senior economics writer at Barron's. Tell me about that story. What do you remember of the perceptions of this place first visiting as a young child?
Yeah, so I was here on a school field trip. I grew up in New York City and was lucky enough to come here with my school class, I think in 4th or 5th grade. I remember being so loud, the opening bell was ringing. There was a lot more people here then. This was a few years ago.
Yeah.
And yeah, it was just exciting. I don't think I understood at all what the market was doing, what the traders at the desks were actually doing, but I liked the energy of it.
Do you have a photo of that moment?
I think there's a class photo. I'll try and find it, yeah.
We got to find that. Good story. Nicholas Jasinski, senior economics writer at Barron's again. No rate cuts this year, the cover story at Barron's. Good to see you, my friend. Thank you.